In the fall of 2019, Warren Buffett sat at his desk in Omaha, reviewing investment files that had caught his attention for months. Like many investors, he had long admired Japanese business culture, the merchant philosophy, the disciplined management, the long-term thinking, but he had never actually invested in Japanese stocks. Until now. In 2019, Warren Buffett sat in Omaha, reviewing something he'd never invested in before: Japanese trading houses, specifically Mitsui and Company, one of Japan's 5 giant conglomerates. Most American investors had forgotten about them, but when Buffett's team pulled their financial records, they found something extraordinary. We were amazed at the low prices of their stocks. Warren Buffett, 2025 letter today, we're breaking down exactly what Buffett looked at before buying Mitsui: management quality, capital allocation, operating earnings growth, commodity cycle handling, and share repurchases. Let's dive in. 1. Management and shareholder orientation. First, Buffett looked at management. Were they shareholder-oriented? Between 2015 and 2019, Mitsui's management team made 3 critical decisions that screamed shareholder alignment. 1. Board diversity and accountability. Mitsui increased independent directors on its board and established governance committees. They weren't just talking about shareholder value, they were building structures to protect it. 2. Conservative compensation. While U.S. executives were earning $20 to $50 million annually, Mitsui's management compensation was significantly lower, often 10 to 20% of U.S. peers. This told Buffett, these managers aren't trying to extract wealth from shareholders, they're building long-term value. 3. Clear strategic plans. Mitsui published medium-term business plans with explicit targets, ROE goals, dividend payout ratios, and growth investment frameworks. They weren't vague, they were specific. Buffett's rule: when management talks about shareholders, I listen. When management acts like shareholders, I invest. Mitsui's management was acting like shareholders. Second question, were they good capital allocators? Mitsui's capital allocation framework during 2015 to 2019 was crystal clear. Priority 1, growth investments. About 70% of cash flow went into strategic investments in energy, metals, food, and infrastructure, particularly in Australia, coal, LNG, and Asia, retail, minerals. Priority 2, balance sheet management. They maintained conservative debt levels. Their balance sheet had ample reserves, which meant they could survive commodity downturns without shareholder dilution. Priority 3, shareholder returns. Only after growth and balance sheet were funded, Mitsui returned capital to shareholders. This is the exact opposite of most U.S. companies that prioritize stock price over business health. Here's the key. Mitsui's ROE target was 15% plus by 2025. They were trying to earn returns above their cost of capital. That's quality capital allocation. Buffett's rule: I want management that treats capital like it's their own. Mitsui did. Third, did they have growing operating earnings? Let's look at the numbers. 2015. Operating earnings were volatile, weighted towards cyclical commodities. 2016. Earnings dipped slightly, but Mitsui was restructuring, shedding weaker assets and reinvesting in higher quality businesses. 2017. Operating earnings rebounded strongly as energy and metals recovered. 2018. Continued growth with food and infrastructure offsetting commodity volatility. 2019. Operating earnings hit record levels, driven by diversified segments, not just one commodity. Here's the critical insight. By 2019, Mitsui had built non-cyclical earnings into the portfolio: food, retail, infrastructure. These businesses weren't dependent on iron ore or oil prices. That's exactly what Buffett wanted: a company that could grow earnings even when commodities slumped. Buffett's rule: I want to see earnings growth that's not just luck. Mitsui's was strategy. Main reasons. Fourth, Mitsui is cyclical. How did they handle commodity price rises? Between 2015 and 2019, commodity prices were wild. Iron ore dropped from $110 per ton in 2014 to $40 in 2015. then rebounded to $90 in 2018 crude oil, $50 in 2015, $70 in 2018, $60 in 2019. Copper. Stable growth, but volatile. Mitsui's strategy was diversification. Energy segment. Benefited when oil and gas prices rose in 2017 to 2018. Metals segment. Lost when iron ore crashed in 2015, but recovered strongly in 2018. Food and infrastructure. These were stable, growing even when commodities slumped. The result, by 2019, only approximately 30% of Mitsui's earnings were from pure commodities. The rest was from food, retail, infrastructure, chemicals, businesses with recurring demand. This is portfolio management. When oil rose, energy profited. When iron ore fell, metals hurt. But food and infrastructure kept growing. Buffett's rule: cyclical businesses are dangerous unless diversified. Mitsui diversified. Fifth, did they repurchase shares at reasonable prices? Between 2015 and 2019, Mitsui's share repurchase program was aggressive. 2016, when the stock was trading at 0.8 times book value, Mitsui repurchased 50 yen's billion worth of shares. 2018, as the stock climbed to 1.2 times book value, they reduced buybacks to 20 yen's billion. 2019, when the stock hit 1.5 times book value, buybacks were minimal, only 10 yen's billion. Here's the key. Mitsui was buying when cheap, not when expensive. They didn't try to boost EPS by buying at 2 times book value. They bought at 0.8 times to 1.2 times book value, which is exactly what Buffett does. Total buybacks plus dividends during 2015 to 2019, 5 to 6% annual yield. Buffett's rule: I only buy back shares when they're worth less than I'm paying for them. Mitsui did the same. So here are the 5 metrics that convinced Buffett to buy Mitsui. 1. P/B ratio, approximately 1.1 times book value, extremely cheap. 2. Total yield, 5.84%, dividends plus buybacks. 3. ROIC versus WACC, expected to exceed 8% cost of capital. 4. Free cash flow, strong and consistent, funding growth and returns. 5. Arbitrage spread, 0.5% borrow cost versus 4 to 6% stock yield. When you combine cheap valuation, strong yield, capital efficiency, and management alignment, you get a margin of safety that appeals to Buffett's philosophy. In 2020, during the pandemic crash, Buffett purchased his first stakes in Mitsui and the other 4 trading houses. By 2025, Berkshire's Japan bet had soared to over $31 billion. The lesson: Buffett didn't buy Mitsui because he predicted commodity prices. He bought because the metrics proved it was worth buying, the arithmetic proved it was worth holding.